The End of Cheap Money and the AI Revolution, Economics Without Myth. Good evening and welcome back to Economics Without Myths, where we cut through the noise and deliver the hard data and insights you need to understand the global economy. I'm your host, Bohdan, and today we are navigating a market defined by stark contradictions. On one hand, we have a central bank in the United States digging in for a prolonged battle against inflation, sending a clear signal that the high cost of capital is here to stay. On the other, we see a global economy fragmenting further, with Europe taking a decisive step to protect its vital industries from geopolitical competition. And meanwhile, the technological revolution continues at breakneck speed, pushing valuations for AI stocks into territory that has many asking if we're witnessing a new paradigm or just another bubble. Today's episode covers a trifecta of critical developments: the Federal Reserve's latest messaging on inflation and interest rates, the European Union's new aggressive tariffs against Chinese electric vehicles, and the ongoing frenzy around artificial intelligence leader NVIDIA. We'll also dive into the G7's efforts to tighten the noose on Russian oil revenues and look at the surprising turnaround in Argentina. But before we get into the details, if you find value in this analysis, please take a moment to hit the like button. It truly makes a huge difference in helping this channel reach more people who need objective, professional economic insights. And if you want to stay ahead of these complex market movements, subscribe and turn on notifications. Your support allows us to continue delivering this ad-free, data-driven content every week. Thank you so much for being here. Let's get started with today's headline story: the Federal Reserve's latest stand against sticky inflation. Segment 1. The Federal Reserve's final warning on inflation. Visuals, charts showing U.S. inflation rates, CPI, PCE, interest rate expectations, and a photo of Fed Chair Jerome Powell. The news. The financial markets spent the last 24 hours digesting new data and statements from the Federal Reserve that have significantly adjusted expectations for interest rate cuts in 2026. Fed Chair Jerome Powell delivered a highly anticipated speech where he reiterated a firm commitment to price stability, emphasizing that the central bank's data-dependent approach means it will require more compelling evidence that inflation is on a sustained path back to the 2% target before considering any policy easing. This message was reinforced by new economic data, including the latest jobless claims report, which showed initial claims rising slightly more than expected. While a slight softening in the labor market is generally seen as positive for fighting inflation, the overall picture remains one of a resilient economy where core services inflation, the kind driven by wages and demand, is proving remarkably sticky. Analysis: why the Fed is digging in. To understand why this matters, we have to look past the headline numbers. The core issue for the Fed is not just where inflation was, but where inflation expectations are settling. The Fed's greatest fear, one rooted in the economic history of the 1970s, is easing policy prematurely. In the 1970s, central banks in the US and Europe made the mistake of cutting rates too soon when inflation seemed to be receding, only for it to roar back even stronger, leading to a long period of stagflation. Fed Chair Powell and the current generation of policymakers are determined not to repeat that error. The current economic landscape supports this caution. The U.S. labor market remains exceptionally tight. Even with a slight increase in jobless claims, the unemployment rate is near historic lows. Wage growth, while slowing from its peak, is still robust. This tightness creates a positive feedback loop for inflation in the services sector, where labor costs are a primary input. Think about health care, education, or even dining out. These prices are directly linked to wages. How does this affect the U.S. economy? The implications for the American economy are significant. First, for businesses, the high cost of capital, the higher for longer narrative means that borrowing for expansion, mergers and acquisitions, and even inventory management remains expensive. This puts a damper on investment, particularly for small businesses and highly leveraged companies. We are seeing a divergence where large, cash-rich technology companies continue to thrive while smaller enterprises struggle under the weight of higher interest payments. Second, for consumers, the impact is twofold. On the one hand, a tight labor market means job security and higher wages for many. On the other hand, higher interest rates make mortgages, car loans, and credit card debt more expensive. The housing market, in particular, is stalled, with high mortgage rates keeping both buyers and sellers on the sidelines. The long-term consequences for global markets. For global markets, the Fed's stance acts as an anchor for global monetary policy. Because the U.S. dollar is the world's primary reserve currency, high U.S. interest rates pull capital away from emerging markets and into U.S. assets. This puts significant pressure on central banks in other countries to keep their own rates high to defend their currencies, even if their domestic economies are weaker than the U.S.'s. This dynamic creates financial stress globally, particularly for countries with high dollar-denominated debt. Verdict: the end of rate cut hopes. The verdict here is clear. The market's hope for significant interest rate cuts in 2026 is rapidly fading. The Fed has effectively signaled that it is prioritizing the long-term goal of price stability over short-term economic growth. Investors who were betting on multiple rate cuts by the end of the year are now adjusting their portfolios, leading to higher bond yields and increased volatility in risk assets. The era of cheap money is firmly in the rearview mirror, and the global economy will be forced to adjust to a new reality of higher borrowing costs. Segment 2. The EU versus China. The EU trade war escalation visuals, graphics showing the EU and China flags, electric vehicles, and charts illustrating the growth of Chinese EV exports to Europe. The news. In a move that significantly escalates global trade tensions, the European Union has announced preliminary tariffs on imported Chinese electric vehicles. The tariffs, which vary by manufacturer, range from 17% to a staggering 38% for certain companies. This decision follows a months-long investigation by the European Commission into whether Chinese EV manufacturers have benefited from unfair government subsidies that allow them to sell cars in Europe at artificially low prices. The investigation found sufficient evidence that these subsidies exist, and the resulting tariffs are designed to level the playing field for European carmakers like Volkswagen, Stellantis, and Renault. China's Ministry of Commerce has already issued a strongly worded statement threatening retaliation against European agricultural and aerospace sectors. Analysis: why this is not just about trade. This move by the EU is far more than a simple trade dispute. It marks a critical shift in Western geopolitical and industrial strategy. For years, the EU has championed free trade and open markets. However, the rapid and aggressive expansion of Chinese manufacturing capacity, particularly in high-tech sectors like electric vehicles, has fundamentally challenged this approach. China currently dominates the EU supply chain and production, with Chinese companies producing high-quality vehicles at costs that European manufacturers simply cannot match without incurring significant losses. The EU's action aligns closely with a similar policy enacted by the United States, which recently imposed tariffs of over 100% on Chinese EVs. This coordinated approach demonstrates a growing consensus among Western allies that China's state-led industrial model poses a direct threat to their economic security and technological leadership. The term de-risking, which has replaced decoupling, is exactly what this policy aims to achieve, reducing Europe's strategic dependence on China for future technologies and ensuring that critical supply chains remain within allied nations. How does this affect European and U.S. economies? For the European economy, the immediate effect is increased protection for its domestic automotive industry. The hope is that by raising the cost of Chinese imports, European manufacturers will gain time to restructure and invest in their own next-generation EV platforms. This protects millions of jobs in the automotive sector, which is a backbone of the German, French, and Italian economies. However, the downside risk is that these tariffs could slow the adoption of EVs by making them more expensive for European consumers, potentially hindering the EU's climate goals. For the U.S. economy, the EU's decision reinforces the effectiveness of its own America First industrial policies, such as the Inflation Reduction Act (IRA). The IRA provides massive subsidies for domestic U.S. production of EVs and renewable energy components. The EU's move effectively creates a larger, unified front against Chinese competition, which strengthens the U.S. position in global supply chains. It also reduces the likelihood that Chinese manufacturers will simply pivot their exports from Europe to the U.S., creating a more stable environment for American companies. The long-term consequences for global markets. The long-term consequence of this trade escalation is a further fragmentation of global supply chains. Companies that operate globally will be forced to choose sides or establish parallel supply chains in different regions. This increases operational complexity and costs for multinational corporations. It also signals a move away from the hyperglobalization model of the last few decades towards a more regionalized, friendshoring model where trade is prioritized among geopolitical allies. Verdict: a new era of protectionism. The verdict here is that globalization as we knew it is over. The EU's decision on EV tariffs marks a point of no return for trade relations between the West and China. While short-term volatility and tit-for-tat retaliation are likely, the long-term trend points toward increased protectionism and a strategic realignment of global manufacturing. This is a significant development for investors as it highlights the increasing importance of geopolitical risk in investment decisions. Segment 3. The AI Revolution and NVIDIA's Dominance. The news. In stark contrast to the macroeconomic anxieties surrounding inflation and trade wars, the technological revolution continues its relentless march forward. NVIDIA, the chip maker at the heart of the artificial intelligence boom, reached yet another historic milestone in the last 24 hours, with its market capitalization continuing to soar to unprecedented levels. The company's stock, which has already seen astronomical gains over the past year, continues to attract massive investment capital as analysts raise price targets and investors scramble to secure a piece of the AI infrastructure pie. The prevailing sentiment is that NVIDIA's dominance in providing the essential hardware, specifically its H100 and soon-to-be-released H200 chips for large language models and generative AI, gives it a near-monopoly position in a market that is expanding faster than anyone predicted. Analysis, bubble, or value? This brings us to the central question in today's market. Is the current AI frenzy a genuine technological revolution or a speculative bubble reminiscent of the dot-com era? The answer is complex, but the evidence leans heavily toward revolution. In the dot-com bubble of the late 1990s, valuations were based largely on potential and future promises. Companies with little to no revenue were valued in the billions based solely on a business plan. Today, NVIDIA's valuation is driven by real-world demand and exceptional profitability. The company generates massive revenue and profits by selling highly specialized hardware to the hyperscalers Google, Microsoft, Amazon, Meta, and other major technology firms. These firms are engaged in an arms race to build out their AI infrastructure, and NVIDIA is currently the only game in town for the most powerful processing units. This isn't to say there isn't speculation. The valuation multiples are undoubtedly stretched by historical standards. However, the underlying technology, generative AI, is truly transformative. It promises to increase productivity across nearly every sector of the economy, from pharmaceuticals to financial services. The market is pricing in the expectation that this technological shift will fundamentally change how businesses operate, creating trillions of dollars in new value. How does this affect the U.S. economy? For the U.S. economy, NVIDIA's dominance represents a significant competitive advantage. The U.S., with its strong venture capital ecosystem, leading universities in AI research, and powerful technology companies, is positioned to lead this technological wave. The AI boom creates high-paying jobs in data science, engineering, and infrastructure development. It also increases capital expenditure in related fields such as data center construction and energy infrastructure. The long-term impact on productivity growth in the U.S. could be substantial, helping to offset the demographic challenges posed by an aging population. The long-term consequences for global markets. The consequences for global markets are twofold. First, it creates a powerful divergence between the U.S. market and other markets. While European and Asian markets struggle with slower growth and geopolitical headwinds, the U.S. market is buoyed by the technological leadership of companies like NVIDIA. Second, it deepens the digital divide between countries that can afford to invest heavily in AI infrastructure and those that cannot. This concentration of power in the hands of a few U.S. technology companies raises questions about competition and regulation, which will be major themes for governments in the coming years. Verdict: the new paradigm. The verdict is that while short-term volatility is inevitable, the AI revolution is real, and NVIDIA is currently its most important enabler. Investors should view this not as a fleeting bubble, but as a long-term structural shift in the global economy. The key challenge for investors will be distinguishing between companies that genuinely benefit from AI adoption and those that are merely speculating on its hype. Segment 4: The Shadow War on Russian Oil Revenues. The news. In a geopolitical development that directly impacts global energy markets, G7 leaders have met to discuss new measures aimed at tightening the enforcement of sanctions on Russian oil. The focus of these discussions is the shadow fleet, an armada of aging tankers operating outside Western regulation and insurance markets that Russia uses to circumvent the G7's $60 per barrel price cap on its oil exports. The G7 nations, led by the United States, are proposing measures to increase scrutiny on maritime insurance providers and to pressure ports that facilitate the movement of these vessels. The goal is to close loopholes that allow Russia to sell its oil at prices significantly above the cap, thereby limiting the revenue available to fund its ongoing aggression in Ukraine. Analysis: why sanctions enforcement is so difficult. The challenge in enforcing these sanctions lies in the complexity of global maritime trade. When the G7 initially implemented the price cap, it relied on Western nations controlling the vast majority of the world's maritime insurance and shipping services. The theory was that if Russia wanted to use these services, it would have to adhere to the cap. However, Russia quickly developed a shadow fleet, buying old tankers from global markets and using non-Western insurance and registration. This fleet operates with reduced transparency, making it difficult to track and enforce compliance. The new G7 proposals aim to tackle this problem by focusing on the supply chain. By pressuring ports to deny access to vessels without proper Western insurance documentation and by increasing penalties for non-compliant shipping companies. The G7 hopes to make it prohibitively expensive and risky for Russia to continue exporting oil at high prices. This strategy is essential for maintaining pressure on Moscow's war economy. How does this affect global energy markets? For global energy markets, these measures create a delicate balancing act. On one hand, effective enforcement of sanctions could reduce the amount of Russian oil reaching the market, potentially pushing global prices higher. The G7 is keenly aware of this risk and is trying to avoid measures that could trigger a global recession by causing a spike in energy costs. On the other hand, a successful price cap limits Russia's ability to destabilize global markets by withholding supply. For the U.S. economy, stable energy prices are crucial for managing inflation. While the U.S. is a major oil producer, global prices still influence domestic gasoline costs. The G7's efforts, if successful, aim to strike a balance between punishing Russia and protecting the global economy from price shocks. The long-term consequences for geopolitics. The long-term consequence is a further division of the global energy landscape. Russia is forced to pivot its energy exports toward Asian markets, particularly China and India, often at a significant discount. This strengthens the economic ties between Russia and these nations but fundamentally weakens Russia's position in traditional European energy markets. The G7's actions solidified the Western alliance's commitment to isolating Russia economically and demonstrate a long-term strategy for degrading Moscow's ability to wage war. Verdict: the pressure continues. The verdict here is that while the shadow fleet presents a difficult challenge, the G7 remains committed to applying economic pressure on Russia. The new measures signal a tightening of the screws, making it increasingly difficult for Moscow to fund its aggression. For investors, this creates ongoing volatility in the energy sector, but it reinforces the long-term trend of Western nations seeking energy independence from Russian sources. Segment 5: Argentina's Great Experiment. The Milei reforms the news. In a surprising development in emerging markets, Argentina has seen a significant rally in its sovereign debt over the last 24 hours, following the passage of key components of President Javier Milei's sweeping reform package. The legislation, which includes measures for fiscal austerity, privatization of state-owned enterprises, and deregulation of the economy, has been met with both intense public protests and strong market approval. This rally signals a renewed confidence from international investors that Argentina, long plagued by hyperinflation and economic mismanagement, might finally be serious about structural reform. Analysis: why markets are optimistic and cautious. President Milei's program represents a radical departure from decades of populist policies in Argentina. The central premise of his approach is a dramatic reduction in government spending to eliminate the fiscal deficit, which is widely seen as the root cause of Argentina's persistent hyperinflation. The market reaction, the rise in bond prices and fall in credit default swap premiums reflects investor belief that Milei has the political will to implement these painful reforms. For emerging market investors, Argentina presents a classic high-risk, high-reward scenario. The country has immense natural resources, particularly in agriculture and lithium production. If Milei succeeds in stabilizing the economy and attracting foreign investment, Argentina could transition from a basket case to a growth story. The market is betting on this transformation, but it remains a highly volatile situation. How does this affect the U.S. economy? While Argentina's direct impact on the U.S. economy is limited, its success or failure holds significant weight for broader U.S. foreign policy and economic interests in Latin America. A stable, market-oriented Argentina would be a valuable strategic partner in the region, countering other geopolitical influences. For U.S. investors, a successful turnaround in Argentina could create new investment opportunities in a market that has been largely inaccessible due to risk. The long-term consequences for emerging markets. The long-term consequences for emerging markets are significant. Argentina's experiment serves as a test case for whether radical free market reforms can succeed in highly complex political environments. If Milei succeeds in taming inflation and attracting investment, it could provide a template for other struggling economies facing similar challenges. However, if the political and social resistance proves too great, it could reinforce the view that these reforms are simply too painful to implement successfully. Verdict: cautious optimism. The verdict on Argentina is one of cautious optimism. The market's positive reaction is a vote of confidence in the political will behind the reforms. However, the path ahead is fraught with challenges, including high inflation, social unrest, and a deeply ingrained culture of economic dependency on government spending. Investors should remain highly cautious while watching for signs of sustainable change. Segment 6, the Daily Wrap-Up and Final CTA Daily Wrap-Up. As we wrap up today's episode, let's look at the critical threads weaving through these disparate stories. The overarching theme of today is the end of the post-pandemic economic anomaly and a return to fundamental economic principles. First, on inflation, the Federal Reserve's message is unambiguous. The battle is not yet won. The higher-for-longer stance is now firmly entrenched, meaning businesses and consumers must adjust to a new reality of higher borrowing costs. This puts pressure on risk assets and reinforces the importance of long-term financial planning over short-term speculation. Second, in geopolitics and trade, the EU's move on Chinese EVs confirms a global shift toward protectionism and strategic de-risking. The era of pure free trade is giving way to a new paradigm where trade policy is intertwined with national security and industrial policy. This will change how global supply chains are structured for years to come. Third, in technology, the AI revolution is rapidly accelerating, creating immense value for companies like NVIDIA. While the valuations are high, the underlying demand and productivity gains appear to be real. This technological leadership reinforces the U.S.'s economic advantage and creates new opportunities for investors who understand the long-term trends. Finally, in emerging markets, Argentina offers a glimmer of hope for radical reform, showing that even seemingly hopeless situations can turn around with decisive leadership. Final CTA. Thank you again for joining me on Economics Without Myths. I hope this analysis helps you navigate the complexities of today's market. If you found this information valuable, please hit that like button to support the channel. And leave a comment below. Let me know which of these stories you think will have the biggest impact on the U.S. economy in the coming months. I'm Bohdan, and I'll see you next time.